Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Thursday, the 11th of July 2024. So, very good morning. Before we start our Daily Dose of Market Insights, as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product. Any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so right now, before we jump straight into the intraday short-term technical outlook for today on the major dollar pair, the major stock indices, and as well as the two key commodities market that we cover on a daily basis, that is i.e. gold, XAU/USD, and as well as West Texas crude oil. Let's have a recap what has taken shape yesterday, as well as early today morning Asia session in terms of news flow, economic data releases, events, and how they impact their respective key cross asset classes. All right, so let's start with yesterday US key important event on news flow first. Yesterday was the second session where Fed Chair Powell addressed the US Congress. So this time around, he addressed the Senate in his usual semi-annual testimony, where he will state the state of the US economy, potential take on the US Federal Reserve current monetary policy stance, as well as answer some Q&A session with the senators. All right, so yesterday he did another session with this time around with the US Senate, but this time around he also started to show subtle signs of a tilt towards a more of a dovish stance, as what the Fed is thinking right now based on the current state of the economic situation in the US. All right, so there's one particular startling statement that he made during the Q&A session. He stated that Powell not prepared yet to say he's confident about inflation. All right, so that's pretty common over here, but he did mention over here is that inflation is receding, but yet confident that price gains are substantially slowing to the central bank 2% goal. All right, then after that, he did mention over here is that more good data would strengthen the central bank confidence that inflation was returning to its 2% target. So that is more or less a bit unchanged, all right, from the previous day semi-annual, we call it a testimony to the House of the Representative. All right, so at the end of the day, right, this entire two what I call it 2 days of semi annual testimony to both the Senate and as well as the House of Representative. There's nothing much major surprises so far, so it's more like a balanced speech over here, but subtly he did give hints that the next step, the next, we call it policy steps that the Fed will take is more earing towards a cut rather than a hike. And that has been more or less been fully priced into the Fed funds interest rate futures market by looking at the CME Fed Watch tool, which we will highlight in our daily dose on a frequent basis. So let's look at this CME Fed Watch tool, the current pricing right now after yesterday's Fed Chair second day of testimony to Senate. So let's go to the probability, the Komai probability. So right now, if you look at the Komai probability over here, so very clearly, right, this month, end of this month, July, market is still expecting the Fed will not move so soon. So no change to the Fed funds rate at 5.25% to 5.5%. That's very high odds of 95% stand pat. Only a small chance of 5% that they may cut by 25 basis points. So the biggest potential cut will come in, the first cut I would say will come in September, 18th of September. All right, so don't forget 18th of September also is that particular meeting the Fed will release its latest dot plot. So what is the dot plot? So the dot plot is a median expectation or projection by the Federal Reserve officials, where they have a view, they project based on whatever data they have at that point in time, where the Fed funds rate will be. So from there, market will have an implied view how much rates they are going to cut this year, next year, and the year thereafter. And also projection of inflationary trend and as well as economic growth in the US. All right, so it acts as an indirect form of monetary policy guidance, all right, as inferred by this dot plot projection. So they'll release it on the same day itself on the 18th of September FOMC, where market participants now, based on the Fed funds interest rate futures, is pricing a high odds of a 25 basis point cut to come in on that day because it's 77%. All right. Then thereafter, Stampede again. There is no change in the November meeting, and almost close to 100% chance that the Fed will cut again before 2024 ends. So that's in 18th of December 2024. So net overall, I could see that given this high odds of pricing, okay, this is almost unchanged. And what's surprising over here is that this one, the second interest rate cut starts to shift to the down more on the higher chance of probability after yesterday's Fed Chair Powell's second day of semi-annual testimony to Congress. So it's almost 100% chance market view at this juncture that the Fed will do another second interest rate cut of 25 basis point to bring it down to the Fed funds rate to 4.75% to 5.5% to 4.75%, pardon me, to 5% before 2024 ends. Okay, so that's based on the current expectation. And since these two interest rate cut has more or less been fully baked into the mindsets of market participants, now the next step over here is that after, in fact, somewhere around September meeting or November, the market participant right now will start to war game. Where will be the Fed standing in terms of their monetary policy next year? That means in 2025. So that will actually impact the FX market, the stock indices, and as well as indirectly gold and other commodities prices as well. All right. So now it seems to us over here is that market also do have a high expectation that the Fed will do another cut at the first meeting of 2025, because if you look at it over here, 68% chance of another 25 basis point cut in the 29th of January 2025 FOMC meeting to bring it down to 4.5% to 4.75%. Then thereafter, another chance. Okay, Stampede over here. All right, in March. Okay, then another cut in April. It was at 89%. It's rather high. So it seems to us that market participants right now has a view that the Fed will start its interest rate cut cycle. That means, what do I mean by that? So that means there will be either a cut followed by a pause, a cut followed by a pause, right? So it's still a cycle because it's not like you cut one time, then you pause it for more than two meetings. Okay, so it's a cycle that seems to be coming into the mindset of the market participants as inferred by this latest data of the Fed funds interest rate futures market pricing compiled by the CME Fed Watch 2. Right, so that also explains to us why the dollar is getting weaker at this juncture, because of the US Treasury yield premium is narrowing against the rest of the world, and as well as given this additional liquidity that is coming into the market is actually supporting risk on behavior as well, not risk on, risk off, risk on behavior as well into the stock market. So what you could see over here is that now moving on to the stock market performance yesterday. So what you could see that the stock market performance yesterday, the S&P and the Nasdaq 100 closed again at another fresh all-time high. And for the S&P for this year, this is, I think, it's the 37th time it made fresh all-time high. A pretty remarkable feat. So the next question more about us: is there an imminent 20% crash coming? All right, like I said earlier on, later I'll show in my technical analysis outlook. Unfortunately, for those who are looking for a 20% crash right now, there's no signs of a bearish reversal yet. We got to look it from a very objective perspective, all right? Because once a trend is trending higher, it could continue to trend higher, all right? So we got to take things one step at a time, not swearing across to some particular negative news flow saying that will there be a potential 20% crash going into place. Okay, so very similar on the Nasdaq 100 as well. All right, a V-shaped intraday bullish reversal right at after the second hour of the US session. All right, so this 11 p.m. Singapore time. where the V-shape recover took shape. And what's interesting over here is that the Dow Jones Industrial Average finally managed to ink out at least a 1% intraday gain. Still remember that the Dow Jones Industrial Average has been lagging behind since the start of this year in terms of their performance as compared to the Nasdaq and the S&P. Why? Because the Dow Jones Industrial Average, they do not have a very significant high weightage on the technology mega cap stocks. Yes, the Dow Jones do have 3 technology big names inside: Amazon, Apple, and Apple, and as well as Microsoft. But these 3 combined weightage is very, very small versus the industrial stocks in Dow Jones, like Capital, okay, and the various banking stocks, and as well as one particular healthcare stock called United Healthcare or something. So overall, the weightage component of Dow Jones is slightly different on how they weight the components of stocks in Nasdaq 100 and S&P, because S&P 500 and Nasdaq based on market cap, whereas Dow Jones is not really based on market cap, it's based on more related to the price of that stock. So this is different weighting scale, all right. But nevertheless, what I could see over here is that the laggards now finally has managed to do a catch up. So I really expect this catch up to take shape. Why? Because of that bull steepening of that US Treasury yield curve that I highlighted at the start of this week daily dose. So for those guys who wants to recap what is this bull steepening, go to Monday's daily dose on over our OANDA YouTube channel, have a fresh recap on that under the Intermarket Analysis time chapter segment, which I segmented accordingly. All right, but nevertheless, later I'll cover that as well during the Intermarket dynamics session, okay, in today's daily dose. So if you look at the Dow Jones Industrial Average, also that very strong V-shaped bullish reversal after 11 p.m. Singapore time yesterday. All right, so net even the Russell 2000 yesterday also managed to ink up a gain of 1.10%. So across the board, 1% gain on the US stock benchmark indices. The heat map of the S&P very clearly almost all in the green. All right, and the market leader as usual again, NVIDIA. All right, so as usual, I share with you all, for those guys who are looking to Nasdaq 100, NVIDIA is a very important component of Nasdaq 100 because it's the market leader or the big brother. Any signs of it showing signs of toppishness, that means i.e. on the daily chart, could give us the pre-warning that the Nasdaq 100 may shape a much more deeper multi-day corrective pullback or correction move. All right, so later I'll share the chart of NVIDIA again, because which I highlighted as well at the start of this week's early this week, I think Tuesday or Wednesday daily dose, these 2 days, saying that NVIDIA at that point in time is not showing any signs of a clear bullish exhaustion because the momentum is still positive. The trend is still in a medium term and major uptrend. All right, so NVIDIA very clearly the market leader among the 7 mega cap stocks, up with a gain of 2.7%. All right, another news flow on the highlight over here is that it's impacted the sterling dollar. So the sterling dollar was actually the strongest performing currency yesterday against the dollar. So what causes the sterling dollar to actually inch up higher? That also came in within our expectation as well. For those who follow our daily dose of market insights on a frequent basis, we do have a short-term intraday bullish bias since late last week on the sterling dollar. So yesterday, there's do have this one of the key influential BOE official peer speaking. So he's in fact the chief economist of the Bank of England over here. So what did he mention over here is that he came out a rather hawkish statement. Okay, so what he did mention over here is that he sees open questions on the timing of the first rate cut by the Bank of England. So what he did mention over here is that he said that services inflation and wage growth, okay, let me highlight up. Okay, growth showed uncomfortable strength. That means in his view, he still deemed that UK services inflation is still rather elevated despite the headline inflation falling to the Bank of England 2% target in May. All right, and based on his comment over here, he did the futures market, okay, yeah, the short-term interest rate futures market in UK, okay, that track the the monetary policy meeting of Bank of England, pointed to only a 50% chance of a 25 basis point cut by the bank on 1st of August, which is next month. So that is currently down from 62% on the prior day on Tuesday. Okay, so after the rather hawkish comments from this influential Bank of England officials, So that has also lead to this strengthening of the sterling against the dollar, causing the sterling to be the strongest currency among the major pair yesterday. All right. So with that, right, that sum up the key data point, and I will say that the key data point yesterday and events that I should cover. So now let's move on to the fundamentals and the intermarket dynamics. Okay, starting with the US Treasury yield curve first. All right, over here. So with this US Treasury yield curve, let us very quickly take a look at it. Okay, so if you look at the 10-year or the 2-year government bond first, okay, 2-year US Treasury notes bond, a bit time to say, the 2 years US Treasury yield, okay, pretty short, has managed to continue to inch downwards. So in the last 4 days, it continued to shape this kind of bearish pennant formation. All right, okay, so no clear signs of any bullish reversal over level. Price action continues to trade below the 200-day and the 20-day moving average ever since the bearish breakdown of that former medium-term swing low of 12th of June at 4.67%. So it seems to us that the trajectory is inching more towards on the downside rather than the upside, with the next medium-term support level to hold at 4.42%. All right. So what I could see over here is the further inching down of this US 2-year Treasury yield, also in line with the 10-year as well. Okay, so if you look at the 10-year, but the 10-year is getting soft as well. Why? Because it's still going to trade below the 20-day and the 200-day moving average, as well as the 50-day moving average, ever since the breakdown of that 4.5% former medium-term support level. But it hasn't started to inch a lower low, because this low here in 14th of June or 13th of June is still higher than, yes, whatever price action that we see so far at the start of this week. Okay, whereas the 2-year Treasury yield, if I go to 2-year Treasury yield, has started very clearly to show lower low. All right, so this is what I call the bull steepening of the US Treasury yield curve, taking into account of the 10-year minus the 2-year. That means right now what you're seeing over here is that the 2-year rate or the 2-year yield is falling at a faster magnitude than the 10-year. Why? Because the 2-year is a much more closer proxy to the US Federal Reserve monetary policy that is causing it to drop faster, because market now is actually implying more or less 2 interest rate cut has already been fully priced by the Fed funds interest rate future market. And based on the current situation, pricing data right now is also showing further signs of further cut in the first half of next year, where I actually shared with you all in the latest pricing on the CME Fed Watch 2. And with that, market is still looking at, there's still no signs of a hard landing. Remember, hard landing means recession. So the 10-year US Treasury yield actually is a proxy to longer term US economic growth. And if this 10-year is falling faster than the 2-year, is implying very, very sluggish demand, all right, on the longer term basis. So given the movement of the 10-year right now versus the 2-year, is actually showing a bull steepening, lower short-term interest rate potentially due to the much more dovish stance that's kind of advocated indirectly or subtly by the US Federal Reserve Fed Chair Samuel annual testimony that was concluded yesterday, but no signs of very clear signs of economic deterioration in the US that will lead to a hard landing or a recession. So that also explains a Goldilocks scenario where it's supportive of the US stock market as well. So that should also explain to us why the US stock market keep on rallying, because of the lack of fear of this hard recession. But that could be a problem when we head into the end of this year, especially if Donald Trump being caught up by the voters in US to head up the US White House administration again, where he may start to ignite his trade war 2.0 against China. That could actually start to see a further deterioration in economic growth via higher inflationary pressures due to his tit-for-tat trade tariffs that could enact tit-for-tat tariffs as well, or measures up from China. So that we got to keep a close eyes on watch when we head towards the end of this year. All right. So with that over here, that as well, this lowering of the softening of both the 2-year treasury yield and the 10-year treasury yield also lead to dollar strength weakness. So very clearly the dollar strength right now has shaped a bearish reversal. Okay, this little tilt inverted V shape right exactly after the test of that 50-day moving average on Tuesday. All right, then we have a bearish reaction, and right now in today's Asia session is also shaping another bearish reaction move. So a very clearly inverted V shape or a bearish reaction right at a key technical element, which is this downward sloping 50-day moving average, also right below the 20-day moving average as well. So net overall, it seems to us that on a short term to medium term basis, the dollar weakness still remains intact on the market by looking at this US technical of this US dollar index. So next support level to watch will be at 104.46, which is corresponding to the 200-day moving average. So there is still some more room to go on the short term basis before the dollar weakness starts to shape another round of pause again. All right, 104.46 with a very clear resistance level over here, the short term one, the dotted line. Okay, let's put it in bold, 105.24%. Okay, so that's the intermarket dynamics between the current situation, the current levels of the US Treasury yield curve that are actually translating to a weaker impact on the US dollar strength. That means i.e. more like a US dollar weakness instead. Okay, now how does this impact the stock market, the US stock market? I did mention something about that that bull steepening. So this is what I'm talking about over here. Okay, let me open up. Yeah, this what share with you. Okay, so this particular chart right at the bottom of my chart, let me expand it. Okay, so this is what I call the potential bull steepening that is taken shape, very prevalent since start of June, middle of June this year, but in fact it really started in late December last year. All right, as the price action continues to steepen upwards. So previously it was at 0%. Still remember that when it came down during about 1.5 years ago, market participants talking about so-called that yield curve inversion, because it went down to zero over here, went down to zero. So a yield curve inversion, if it's going to persist, right, it actually telling us that high odds of a recessionary or a hard landing in the US. But this hard landing condition is getting lesser and lesser at this point in time as the yield curve continues to steepen. And this is not a bear steepening, it's a bull steepening. Why? Because like I expressed to you all, the current state of affair right now, where we start to see this latest round of push up from here, from the low of 17th on June until yesterday's whatever current price that we see, it's being led by a much more higher magnitude of the 2-year dropping at a faster rate compared to the 10-year. Okay, the 10-year yield. All right, so that's why I call a bull steepening. So basically, mathematically, you just get the 10-year yield minus the 2-year yield of the US Treasury. Okay, so notice that previously there's also another bull steepening that took shape right after once the pandemic has more or less been the negative effect of the pandemic has more or less been subsided in August 2020 to March 2021. Okay, this period here. Okay, this period here. So now let me reduce the period again. I restore it. Okay, so notice that during this period here, when there was a prior bull steepening, we realized that this line here is actually the relative strength of the S&P 500 enhanced value ETF. So what this enhanced value ETF means, in short, it's still the same component stock inside the S&P 500, except that Microsoft, Apple, Nvidia is not the top weightage. Okay, the top weightage is weighted accordingly to their value factor. That means banks will be one of them, energy will be one of them. Component stocks within the S&P 500 has a higher value factor will be ranked at the top, and those who have a lower value factor will be ranked at the bottom. So if we look at during this point in time, right, when there is a bull steepening that occurs during August 2020 to March 2021, the enhanced value S&P managed to outperform the normal S&P 500, which is the SPY, the ETF. All right, that means there is this outperformance of value-related stocks over the S&P 500. All right, that means, i.e., the technology stocks, the mega cap stocks, is taking a back seat at that point in time. All right, so you could see it over here where the momentum actually underperformed the S&P 500. So momentum tends to be centered around the technology mega cap stocks. So same thing, this S&P 500 momentum ETF is driven by S&P 500 component stock that has a higher momentum factor will be ranked at the top. So if you could Google the SPMO ETF, you look at the fact sheet, at this point in time, the top weightage is still the NVIDIA, Apple, Amazon. It's the mega cap stocks that is at the top 10. We call it component stock within this SPMO ETF. All right. So at this juncture, right, ever since there's a bullish breakout of the momentum factor on February this year, it's going to hit higher high and fresh all-time higher. So this is in fact the market leader so far right now, because price action going to go higher and higher, making fresh all-time highs in terms of their relative strength against the S&P 500. But given this particular bull steepening that is taking shape, it could lead to a very similar medium-term movement, outperformance movement of the value against the S&P coming pretty soon as well. Because right now, at this point in time, the ratio or the relative strength is still sloping downwards. All right, but if this bull steepening starts to be more prevalent, especially with the break of this key resistance level at negative 0.08%, I do reckon that based on its prior movement over here, we may still start to see a bit of value outperformance against the S&P 500. So that could also explain to us the Dow Jones Industrial Average could actually start to cover its gap of underperformance that we see so far this year over the S&P 500 and the Nasdaq 100. All right, so that means, i.e., the value factor languid right now, but it may start to do a pretty much of a catch up pretty soon, which is healthy, which is a healthy sign of a ongoing broad-based bullish trend in the US major stock indices that it starts to broadening out towards the laggards, which is the Dow Jones Industrial Average, heavily concentrated by value component stocks like the financial, energy, and healthcare. All right, so this is the intermarket dynamics I want to share with you all for today. So now let us now move ahead and cover the short-term intraday technical outlook, starting with the FX market first. So before that, let me expand my screen so that you guys could see the key levels much more clearer. All right, so let us start with the FX market first. All right, so before we start on the FX market, very quickly, let us take a look at the 5-day rolling performance of the dollar against the major currency as of right now we are speaking. All right, so this is a 5-day rolling performance, a very good gauge of intraday movement of the dollar against the major currency. So what I could see over here is that the sterling was the top performer yesterday, or indirectly you look at the dollar was the worst performer against the sterling, all right, at the bottom. So even the fact that yesterday the Kiwi was very weak, where you see the dollar was the strongest against the Kiwi, this gap also managed to come down as well, moving in line with the broad-based 5-day rolling performance dollar weakness narrative that is still playing out in the market right now. All right, so yesterday push out of the Kiwi was due to that rather shocking dovish RBNZ monetary policy statement, which I covered much ground yesterday, so I do not want to repeat again. But what's interesting over here is to watch out for the dollar yen now, because the dollar yen so far has been rather stable, no signs of any dollar strength, dollar weakness coming back into against the Japanese yen, whereas we start to see very clear dollar strength weakness against other major currency like the Aussie, the Euro, even the Sing, and as well slightly against the Swiss franc and as well as the Chinese yuan. All right, even the dollar CAD also start to inch downwards as well. So however, the dollar JPY continues to be rather stable, something to keep an eye to watch out for, especially with a key economic data that is coming out today, which is the US CPI data. We'll touch more about that later at the end of today's daily dose. All right. Now, with that, let us now shift our perspective to the intraday technical outlook on the dollar major pair, starting with the euro dollar first. All right, over here. So with the euro dollar over here continues to inch up higher, almost hitting the resistance level that we highlighted. No clear signs of any bullish exhaustion yet. Why? Because the price action of the hourly RSI going to shape a higher high, hasn't even hit the overbought region yet. So with that, we will have a slightly tightened key short-term pivotal support for today on the euro dollar. So that is yesterday's or Tuesday US session intraday low. Very clearly, this is being supported, tested 1 time, 2 times, 3 times, 1.0805. So 1.0805 will be the short-term pivotal support level, still maintaining that short-term intraday bullish bias as it's going to trade within this minor ascending channel that in place since 26th of June low. All right, a breakup above 1.0860 the upper limit of the first resistance zone may expose the next near-term resistance level at 1.0875, which is the upper limit of this minor ascending channel, as well as the 0.382 Fibo extension taken from the low of this 26th of June, which is potential also a fifth wave target as well. Okay, in terms of the Elliott wave perspective. However, if we start to see a breakdown below 1.0805, then today's intraday bearish bias will be invalidated, where the euro dollar may start to do a deeper pullback to deeper minor corrective pullback to retrace some of its gains that was being made from 26th of June all the way up to 8th of July, with the next support level to watch out for at 1.0790, followed by 1.0770 on an intraday basis. All right, okay. Now, sterling dollar. So the sterling dollar, the cable has managed to hit our resistance level at 1.2860 level over here. So now it's already at the overbought level. Why? Because the speed of the move is much more faster, given the fact that yesterday's rather hawkish comments from one of the influential Bank of England official, Peel, which I highlighted earlier. So, but what you could see over here is that yes, it's in overbought, but however, the overbought level doesn't show any signs of a bearish divergence over here. So what it means at this point in time is that there could be a minor pullback taking shape, but not rather a steeper minor corrective pullback to retrace much of a gain, or more than 23% of this movement here that has been seen from 2nd of July all the way up to yesterday's intraday high. All right, so it's more like a minor pullback rather than a steep minor pullback instead to take shape, given the fact that the RSI is overbought, but there's no bearish divergence on its condition right now. Okay, so with that, we will have a very tight short-term pivotal support level in line with the key risk event that is taking shape today, which is the US CPI data release. So this particular level is very pivotal, or very crucial. Why or important? Because it's the former, very clearly in terms of psychological perspective, former minor swing high refuses to break for a few sessions. Then thereafter, after it break, it shaped that very steep move yesterday, and also it also confluenced with the lower limit of this minor ascending channel from 2nd of July. So 1.2820 short-term pivotal support level. So as long as the pullback that's taking shape later potentially didn't surpass below 1.2820, that means there's no hourly close below 1.2820, we will still maintain that short-term intraday bullish bias on the sterling dollar. Next resistance to watch out for is at 1.28820, 1.2880. Above 1.2880, we'll see the major resistance zone of 1.2920/1.2940, which is a Fibo extension level taken from the low of 26th of June at 0.618, and as well as graphically, this gray line here that I drew is a long-term circular descending trend line that is in place since 2nd of June 2014. Okay, so that's close to what, 10 years, decade long descending trend line that has kept previous major uptrend of the sterling dollar from breaking up higher. All right, something of a level graphically we got to respect of once it comes to this level over here. Okay, only an hourly close below 1.2820 will invalidate today's intraday bearish bias. A bullish bias, sorry, I repeat again, a bit tongue twisting. Only a break below 1.2820 short-term pivotal support level for today. That means an hourly close below 1.2820 will invalidate today's intraday bullish bias on the sterling dollar to shape a much more deeper minor corrective pullback to expose the next near-term support at 1.2780/2760. A break below it sees it dipping further to 1.2735/1.2710. We also confluence with the rising 20-day moving average as well. Okay, right now, moving on will be the dollar major pair against the Asia Pacific currency, starting with the Aussie dollar. So for the Aussie dollar, no change, it's going to inch up higher and higher. So right now, it already start to shape a higher high over here. Okay, so very clearly, it already broke out from the previous high. Okay, so with that, it's coming very close to this first resistance that we highlighted since the start of this big daily dose, 6780 level. So with that, I could have a rather tightened key short-term pivotal support for today, given that it start to shape a higher high. So my pivotal support for today will be at this level here. Oops, let me copy, paste. Okay, 6720. Okay, 6720. Then this level here will be the next support. Okay. Okay, good. So as long as this Titan key short-term pivotal support holds for today, 6720, still maintain that short-term intraday bullish bias on the Aussie dollar above 6780, potentially sees the next near-term resistance coming in at 6825/6840, which is the 1.618 Fibo extension taken from the low of 10th of June, and as well as graphically, if you look back over here, it's this congestion area over here from 29th of December to the early part of this year, 2nd of January 2024. And let's move back again. Okay, only hourly close below 6720. That means if the price action starts to dip down and break below 6720, then this particular short-term intraday bullish bias will be invalidated to see the Aussie dollar shaping a much more deeper minor corrective decline to test the next near-term support at 67 figure, and potentially thereafter 6670 on the intraday basis, also conferencing with the rising 20-day moving average as well. Okay, dollar yen. So dollar yen, like I said over here, is that this is only pair that is showing no signs of a dollar exhaustion, okay, as going to trade sideways. So what you could see over here is that at this point in time, yeah, price actually going to push higher high, but very interestingly, right, the hourly RSI has started to shape a lower high. Okay, let me explain. Okay, you can see a lower high. Was price going to inch up higher yesterday, and it didn't break 61.95. So with that, right, what I could do over here is that I would use a slightly, okay, still no change, is at this 61.10. So still neutral between 61.95 and 61.10. Only a bearish breakdown below 61.10, then I would have been more confident to validate a short-term intraday bearish bias on the dollar yen, to actually expose the next near-term support at 160.30, followed by 159.90 on the intraday basis. So this 159.90 also corresponds to the rising 20-day moving average as well. So net overall, what you could see over here is that the short-term uptrend remains intact on the dollar yen. Unless it starts to break below 159.90, then we will see a much more deeper minor corrective pullback. Within is still medium term that is still trading the uptrend. Why? Because the price action is still holding above the 50-day moving average. All right. So what we could see over here is that the dollar strength is still rather quite strong against the yen, but I'm not confident to actually have an outright bullish bias. Why? Because the other dollar major pair is not showing any clear signs of a dollar strength, but more of a dollar weakness. And inherently, individual, the dollar yen itself is also flashing out a bearish divergence as being flashed out on its hourly RSI. So this gives me the lack of confidence at this point in time to see the dollar yen pushing up higher above 61.95. Let's see how it goes. So neutral between 61.95 and 61.10 for now. Okay, so now that sums up the short-term intraday technical outlook for the major FX pair. Now let us shift our focus to the major stock indices, starting with the Hang Seng Index first, which is the Hong Kong 33, one of our key major Asia stock indices that we cover on a daily basis. So yesterday we did highlight that we have a Titan short-term pivotal support at 17,380. Price actually indeed bounced, hit the first resistance before trading that pullback again. So still no change. This level here is indeed a crucial short-term pivotal support to watch to maintain our short-term intraday bullish bias on the Hong Kong 33 or the Hang Seng Index. Above 17,790 potentially takes us up higher towards 17,970. So this 17,970 is also very crucial. Why? Because it corresponds to the upper limit of this short-term descending channel that is taken from the high of 5th of June. So unless we start to see a very clear bullish breakout above 17,970, then we could substantiate a much more deeper and much more stronger recovery on the Hong Kong 33. If this level is not being taken out again at 79.70, there could be a risk that the Hong Kong 33 will start to trade again below, much lower within this descending channel, and the lower descending channel limit is at 17,170, which is the 200-day moving average. So i.e., if today's price action starts to break down and break below the 17,380, then we'll start to see it drifting down to have a test at this key medium-term support level of 17,170, which correspond to the 200-day moving average, and as well as the lower limit of this minor descending channel All right, so that's for the Hong Kong 33. Moving on will be the Nikkei 225. So on Nikkei 225, let's look at the daily chart. So very clearly, a very strong bullish momentum play on the Nikkei 225 over here. So what you could see over this, the daily time frame, fresh all-time high again yesterday. No signs of any bearish exhaustion at this point in time, except the fact that the daily RSI is at the overbought level. But at this point in time, there is no bearish divergence on the overbought level yet. Okay, so net overall momentum is still positive from a medium term perspective. How about on a shorter term basis? So on a shorter term basis, the hourly RSI has already hit the overbought level. So yesterday it's already hit our resistance level at 42,000 and 42,280 level. So what we could see over here is that it's now trying to actually inch down back into the up this very short-term minor ascending channel that I drew from the low of 2nd of July. So mind you, this is a first 1 hour chart. So intraday technical outlook always on the 1 hour chart. So why do I do on the daily chart? Because daily chart, it gives me a better picture on the current medium term momentum. Okay, so if the current medium momentum starts to be bearish, then we could play that whatever potential counter trend pullback much more confidently. All right. So given that the medium term momentum is still bullish over here, whatever potential pullback that is shaping right now is more of a minor in nature rather than a deeper one. So the support level that we got to watch out for in short term for sure will be the lower limit of this minor ascending channel, which will correspond to the former minor swing high of 9th of July and 10th of July. Okay, so net overall, right, the RSI now is trying to, it has already exited from the overbought level, so it has a bit more room to go before hitting this barrel support over here that managed to help since the low of 2nd of June 2nd of July, okay, 8th of July, 2nd of July over here. All right, so previously where it hit this support level, the price action of the Japan 225 managed to shape that very strong V-shaped recovery. So who knows, potentially based on the observation on the past movement of the hourly RSI in conjunction with the raw price action, it means that there could be a bit more of a minor pullback to take shape before hitting the support level over here. Then before that, the Japan 225 could either shape another bullish impulsive up move. So with that, given that the fact that here to here over here, it doesn't seem to be much meat to play for that minor corrective pullback. I'll rather wait for the dip to take shape. So what we could see over here, if I do that Fibo retracement for the first support slightly higher above the 41,690 level. Okay, so if I were to do this, take it from the low over here, push it up. Okay, this is the 23%. Okay, what is it? Okay, let me highlight this. Yes, push up here. Okay, the 38% will be here. Okay. Okay, also this meeting line here between the two candle. Okay, so this could be the first support level to watch out for that minor pullback for the 1,890. Okay, so as long as this pullback didn't surpass 41,690 over here, we will still maintain that short-term bullish bias for a potential reversal then around this level, this zone here. As long as 41,690 holds, the Japan 225 continues its bullish uptrend in the shorter term, with the next near-term resistance to watch, which is a bunch of Fibo extension cluster level, 42,690, followed by 42,895, and potentially even 43,140. Okay, only an hourly close will break down below 41,690 will invalidate the Japan 225 bullish intraday bias for today to shape a much more deeper corrective pullback, still within its short-term uptrend. Why? Because it's still holding above this rising 20-day moving average. The next support level to watch will be at 41,090, followed by 40,080 / 40,506 level. Okay, this next cluster of support over here in the short-term intraday basis. Okay, so that's sum up for the Japan 225. Let's move on to the European indices, which is the German 30 or the German DAX. So the German DAX is going to squeeze up over here, but after it squeeze up, the squeeze up stop right exactly at the 50-day moving average, and also this former descending trend line resistance that I drew from the current all-time high that has a failure bullish breakout that took shape on last Friday and this Monday. So with that, I'll be using 18,520 as my key short-term pivotal resistance for today. But however, first support, it got to break down below it, will be at 18,400 over here, 18,400. Only a breakdown below 18,400 may revisit the 20-day moving average and also close to the minor swing low of 9th of June and 10th of June that is acting as a next near-term support at around 18,235. However, if you start to see the hourly close above 18,520, then this German 30 will do a squeeze up again above 18,520 to revisit last Friday and last Tuesday, this Monday swing high at 18,640. Above it exposes 18,750. That means if price action able to clearly goes above this level, then we will start to see potentially the start of a much more meaningful recovery in the German 30 index or the German DAX. Now, with that, let us move to the major US stock indices, starting with the Dow Jones Industrial Average or the US Wall Street 30. So finally, it managed to break out above this so-called short-term range configuration over here that is in place since 24th of June. Okay, it broke out yesterday, hitting our resistance level as well. And right now it starts to be in the overbought zone as it depicted on the hourly RSI. So with that over here, there could be a chance of a pullback taking shape again. So first pullback level for sure will be yesterday's range resistance that's now become a pullback support at 39,620 level, but I will use it at a slightly lower level, 39,500. So this 39,500, if you do the Fibo retracement of yesterday's push up, it also corresponds very closely to the golden ratio of 61.8. So as long as this pullback is surpassed below 39,500, that means no hourly close below 39,500, we will still maintain that short-term intraday bullish bias on the US Wall Street 30 or the Dow Jones Industrial Average. Above 39,790 exposes the next near-term resistance 39,900, followed by the current all-time high area at 40,055. Only hourly close below 39,500 will invalidate yesterday's bullish breakout and see another round of choppy corrective decline movement to retest its range resistance lower limit or the range configuration lower limit at 39,190, which correspond to the rising 20-day moving average. A breakdown below it exposes 39,090 / 39,030, which correspond to the 50-day moving average. Okay, with that, now let us look at the Nasdaq 100 over here. So before we take a look at the Nasdaq 100, like I say, let's have a quick look at NVIDIA, given the fact that at the start of this daily dose, NVIDIA do have a significant influence on the movement of the Nasdaq 100. Why? Because of its very high component weightage inside the Nasdaq 100. Okay, so very quickly, NVIDIA, let's have a quick look at it. So NVIDIA over here, like I mentioned, yesterday or the day before, it continues to trade within a bullish dynamic over here, very strongly holding above the 20-day moving average, with the RSI still showing very positive momentum and haven't even hit the overbought region yet at this point in time. All right, so net overall, what we see NVIDIA over here, it's still trading in a very positive uptrend, both in terms of short term and medium term. Why? Because price action going to trade above the 20 and the 50-day moving average, and bullish momentum has yet to be residing, okay, as depicted by the current condition on the daily RSI. So that could also support the ongoing intraday bullish movement of Nasdaq 100 on the hourly time frame chart over here. Yes, it's going to push up, hit our resistance yesterday at 20,620, 20,710, which is a bunch of Fibo extension cluster level. RSI, hourly RSI already overbought, now attempting to exit from the overbought level. But while it's hitting the overbought level, while he hit the overbought level, it didn't shape a bearish divergence as price action going to shape higher high. Okay, so what I could see now over here is that as it worked out from its overbought condition yesterday, it may start to slope downwards or inch downwards. There could be a minor pullback in first step on the Nasdaq 100 today. So as long as this minor pullback didn't surpass a tightened key short-term pivotal support that I highlighted today, which is at 20,420, which is yesterday's minor swing low that was previously the minor congestion level previously at the start of this week. And if you do the Fibo retracement from the ongoing rally over here, this will confluence with the 23% Fibo retracement as well. Okay, so as long as 20,420 holds in the minor pullback, still maintain that short-term intraday bullish bias on the Nasdaq 100. Next resistance level to watch 20,900 followed by 21,040, which is the another Fibo extension level of 2.618. Also the upper limit of this minor ascending channel that I drew from the low of 21st of May. Only an hourly close below 20,420 will invalidate today's intraday bearish bias to see a deeper minor corrective pullback to test the lower limit of this minor ascending channel that is coming to expose the next support area at 20,210 followed by 20,000, which is the lower limit of this minor ascending channel, and also confluencing with the rising 20-day moving average as well. All right, so that sums up the intraday technical outlook from the major stock indices. Now let us move on to the commodities market, starting with gold XAU/USD. So for gold XAU/USD, yesterday it almost hit our first resistance at 2,391 before coming back down. Clearly, momentum still remains very positive in the intraday basis, while as RSI continues to hold above this parallel ascending trend line. Okay, as even hit the extreme overbought level yet. So still no change. I do not want to put it so tight. So it still will be a zone. 2,362/2,350 short-term pivotal support level. So as long as this short-term pivotal zone holds, support zone holds, we will still maintain that short-term intraday bullish bias on gold XAU/USD above 2,391 exposes 2,410, which is the 2 times Fibo extension level taken from the low of 26th of June, the upper limit of this minor ascending channel that I drew from the low of 26th of June, and graphically previously also this former minor congestion area of 21st of May and 22nd of May. Only hourly close below 2,350 or level over here will invalidate today's intraday bullish bias to see a deeper corrective setback or pullback to retest the 20-day and the 50-day moving average, acting as a support area as well at around 2,035. Below 2,035 will actually see a much more deeper slide to retest the low of 1st of July and 2nd of July at 2,318 level. All right, now moving on will be the West Texas crude oil. So yesterday, yes, Texas crude oil bounced as expected. So let's have a clearer picture on the daily time frame. So on the daily time frame over here, the price action, the way it bounced yesterday was rather strong. By looking at this hammer over this strong little low tail hammer, a very long tail. Then after that, the body of this daily candle managed to cover the body of that small little black candle on the prior day on Tuesday. So taking with these two candles over here, the price action is rather positive in terms of momentum, and it tells us, for those who want to know the definition of these two Japanese candlestick, is a bullish engulfing. So indicating to us that since it's being formed on the daily time frame, a higher time frame, on the intraday basis, it may continue to push higher around this congestion area over here. Okay, so that's why with that positive bullish reversal engulfing candlestick that is being formed on the daily time frame, on the hourly time frame, I got no conviction for it to shape another low again to break down below 81.30 for today at this point in time based on the technical configuration. So with that, I'll be using 81.30 again, no change at yesterday's short-term pivotal support. It already hit the resistance level that we highlighted, 83/83.45. okay, the lower limit of it. So right now still maintain that bullish bias, intraday bullish bias on the West Texas crude oil, and also the hourly RSI hasn't even hit the overbought level yet at this juncture. So above 83.45 potentially could see a retest on last Friday minor swing high at 84.40 in the first step. Only an hourly close below 81.30 will invalidate today's intraday bullish bias. Pardon me, a break below 81.30 will invalidate today's bullish bias to kickstart another multi-day corrective decline scenario towards the next near-term support in first step at 80.56, followed by 79.90, which confluencing with the 50-day and very closely the 200-day moving average as well. All right, so that sums up for today's intraday technical outlook on the major cross assets. So before we go, let us have a quick look at the economic calendar to take a look what are the key data to look out for today, other than the US CPI data that is out later. So for today, Thursday over here, what we have during the European session, I think this shouldn't be a big surprise because this is the final number. So the preliminary number was released about a week ago. So we do have the final inflation rate number for Germany for the month of June out at 2 p.m. Singapore time today. Then thereafter, for UK, we do have the monthly GDP data out at 2 p.m. Singapore time as well, followed by the industrial production data for May as well as the manufacturing production data for May, also at 2 p.m. Singapore time. Then thereafter, this the all important one for today will be at this 1 hour before the start of the US stock market session open at 8:30 p.m. Singapore time, the core inflation rate for US, or the inflation data for US. So the core inflation rate over here, market participant expected to be rather tame, very similar to last month figure of 3.4% year-on-year increase in the month of May. So almost unchanged, 3.4%. So the only big surprise over here is that if this thing starts to inch up much higher to, let's say, 3. If you look at the trend of the core inflation right now, it continues to show signs of that decelerating over here. So if it continues to go up above 3.6%, that was April's number, then potentially we could see dollar strength coming back in the picture, and we may start to see a much more deeper minor quality pullback in the stock in the US stock indices. All right, and if you start to look at another one, will be the services inflation over here. So the service inflation is still remains rather higher at an elevated level. So this services inflation also, some of the Federal Reserve officials that monitor this, they are more erring towards the less dovish camp. So this number, but however, it starts to inch down slightly lower compared in the last 2 months, 5.3 to 5.2% in May. So if it continues to go down much lower again today, that's also pretty much encouraging in terms of this ongoing bullish, short-term intraday bullish bias on the major US stock indices, and the short-term intraday bearish bias on the US dollar. Okay, but the only big risk that if this services inflation starts to tick up higher to go above the 5.3% level, then that could be trigger a minor intraday risk off impact on the market. All right, so with that, do have a great day ahead. This is Kelvin here signing off, so we shall speak again tomorrow. Thank you.